Hello, everybody, and welcome to the very first Verdence Capital Advisors market commentary. It's August 10th, 2017. So the markets have been somewhat volatile over the last couple days. There are geopolitical events, tensions between North Korea and the United States. We're seeing a flurry of earnings news coming in, some good, some bad, causing some dislocation in the market. And yet the S&P 500 continues to set new highs and continues to stay at elevated levels. However, we're starting to see something underneath the market from the broader market that is interesting to us, and we thought we would point out and start to talk about valuations and what we see. So let's dig in. To start with, as we'll see on the first chart, the economic environment continues to remain steady and solid. Plus 2% on GDP. Growth continues to move at a moderate yet consistent pace, and that's helping drive earnings. We also see that unemployment continues to be very strong. Unemployment continues to fall. The unemployment rate is now potentially heading under 4%. Now again, 5% is full employment. So claims are down, the unemployment rate is down, and that is causing productivity to start to rise and capacity to start to be used up. So the economy continues to move forward, and yet we don't see inflation. This next chart shows us that inflation is still hovering somewhere right around 2%. So we have low inflation, we have low unemployment, and so that has allowed the Federal Reserve to start to take a more active role in policy. And so as we see on this next chart, where is that inflation? Why aren't we higher considering the run-up in the economy? And on this chart, we see that the Federal Reserve's balance sheet, which is represented in the blue, has exploded since the crash of 2009, going from roughly $400 billion to $4 trillion. But as you can see in the last couple of years, the Federal Reserve is slowly starting to decrease its balance sheet. And so when the question is asked, where is inflation? And we see the orange line, which is the actual supply of money, M2, all of that capital that was thrust into the market by the Federal Reserve didn't actually make it into the money supply. The banks held on to the money, and many people think that eventually ended up in the markets, helping to elevate stock prices. And on the next chart, we can see not only is the Federal Reserve reducing its balance sheets, but they've already started to raise interest rates. The green line here represents the pace which the Federal Reserve expects to raise rates, which, as you can see, is faster than what the market expects in the brown. So if inflation stays low and the economy continues to move high, then the Federal Reserve does not have to be aggressive. However, given the growth in earnings, given the growth in the economy, given the worldwide recovery in the economy, we think that the Federal Reserve is going to have to take perhaps a more accelerated pace than the market expects. Now, the result of that is higher interest rates. This next chart shows U.S. interest rates over 72 years. And in fact, as you can see, if we were to add the last couple years to this chart, it's an older chart, we would have 74 years of interest rate movements. So for 37 years, interest rates went right up from the post-World War II era all the way through the days of Paul Volcker when he was trying to break inflation, and we saw massive interest rates on bonds and massive inflation in the 80s. And for the last 37 years, we've seen a consistent pattern down in interest rates. This is important. The market loves symmetry. In fact, if we were just turn this chart upside down, essentially we're looking at price. The inverse of yield is price. So we know we like to buy low and sell high. Therefore, if yield is inverse to price, the single lowest or cheapest time to buy bonds was in the 1980s during the periods of high inflation. Buy the bonds, capture the yield. We are at very high prices / very low yields. So this is the first chart we're going to look at that speaks to one of our primary concerns in the market. Everything is so good, there's so little worry about assets right now that prices are elevated. Now, that's not to call for a great bear market in all assets. However, what has to be acknowledged is as prices go up and up and up and become elevated, then your potential return goes down. And we have to look and say, okay, what is our return relative to the risk we take? And if we look on the next chart, this is a good example of that in the bond market. Bonds have been so good for so long, people forget that there's risk in long bonds. This next chart shows what's called the Great Massacre of 1994. In 1994, the Federal Reserve raised rates very quickly. We saw the 10-year Treasury go up significantly. We could see in 1994, the Treasury, the 10-year Treasury, lost 23% of its value, and that's in a one-year period. So, is it possible for Treasuries to see considerable volatility? And the answer is absolutely. So we must take caution when we see interest rates this low and we look at a long-term downward trend. This is a time to be careful. We don't want to own long bonds. We don't want to own long Treasuries. If that trend line, that 37-year trend line is broken, we may start to see the next secular move higher in yields, and of course the inverse of that would be lower prices. Now in terms of stocks, we continue to see stocks drive higher on the back of higher corporate earnings. As we can see in the chart on the left, corporate earnings continue to grow and continue to recover since the Great Recession in 2009. We did see a dip in 2015, largely driven by energy stocks, and energy earnings have recovered and so have corporate earnings. So, as we continue to see earnings rise, as the dollar stays flat, as energy recovers, our expectation is that earnings will stay strong. The real question, though, is how much are we paying for those earnings? Additionally, high yield spreads are at extraordinarily low levels. Now, quickly, a spread is the yield on a high yield security or a junk bond versus a treasury. So if a treasury is 2 and a high yield is 10, that's an 8% spread. Right now, we're seeing incredibly low spreads. What does that say? It says that the market's not worried about credit. It's telling you that the market is demanding very, very little premium for a high yield / junk bond relative to a treasury. No one's worried. Once again, we go back to the theme. We're not calling for a great high yield credit disaster. However, we have to ask the question, is it worth the risk we're taking for such a small premium over treasuries? As you can see by the chart, just in 2015, 2016, when everyone was worried about China and energy, these spreads were at 8% higher than treasuries, and today we're back down under 4%. As a matter of fact, just as a side note, we just saw Argentina, a country that's defaulted on multiple occasions, put out a 100-year bond for just over 3.5%. So again, the question, do you really want to take that much risk for 100 years for less than 4%? By the way, the Ivory Coast of Africa, that nation, which has had numerous military uprisings, under 7%. There's not a lot of concern about credit risk in the marketplace. So higher corporate earnings, low credit spreads, a Federal Reserve that is not being necessarily aggressive. What does that all equate to? Higher stock prices. So here we see in the white line, the S&P 500, once again this year, doing very well, setting record highs, very elevated. There's a handful of names that are driving the S&P 500. Like in 2015, this is a more narrow advance by the S&P 500, where the larger hot dot names are really driving the return of the S&P. What's interesting, though, on this chart is the orange line. The orange line is the value line index. It's over 1,700 stocks, and it's a geometric mean weighted index, which is to say that the stocks, each stock has a greater impact on the outcome of the index than the market cap weighted S&P. That's important in this analysis. We use value line as a proxy for all stocks, as opposed to just the handful of dominant players in the S&P. So as you can see this year, the two indices have had a divergence. The value line index is actually just barely above break even, while the S&P 500 is having very impressive double-digit gains. This happens once in a while. It tends to happen as markets start to hit tops, the markets become exhausted, and they chase after the handful of hot names. What also tends to happen during these times is, as individual stocks have any trouble, the market sells them, they run away from it, and they go chase that hot return. This is a time where investors start to throw money at high-priced securities, and once again, same theme, we're getting less return for taking on more risk. The higher the price, the more return that's already been taken out of it. So what we look for in this environment is there a divergence? How wide is it? And more importantly, what happens next? What tends to happen after one of these massive divergences is we get a bout of volatility and we get change in leadership. For example, In 1999, we can see this is one of the most dramatic divergences between the value line and the S&P 500. As a matter of fact, as you can see late in the year, the value line stocks really started to tumble early and at a much faster pace than the S&P 500. Now, what we know is this was the end of the dot-com bubble, where all these tech stocks and big large cap US stocks went to elevated price levels, and the market turned over, and we saw a lot of volatility for the next 3 years, a bear market. Value-oriented stocks had a huge recovery on the other side of this move. The next chart shows 2007. Again, late in the year, big divergence between the two. The overall stock market started to fall well before the S&P 500 and to a greater degree. Again, 2008, a lot of volatility, leadership change. 2011, another divergence. The S&P 500 was up about 1%, but the average stock was down significantly that year. 2012, European financial crisis, volatility, leadership change. The latest one was 2015. 2015, we saw a massive divergence again. This was the year in the S&P 500 where the top 10 stocks were up about 15%. The other 490 were down almost 5%. Overall, the index, the S&P 500 index, was up a little over 1%, and yet the value line index was down 11%. Broad market not doing as well as those handful of names. What was the result? We saw a lot of volatility at the end of 15, early 16. China, energy, the market basically had a bear market for every other asset but the S&P 500, and the S&P 500 came pretty close. On the other side of that, a rally, a change in leadership. So the message here is simple. We look for repetitive patterns. There's an old saying in the market, history doesn't repeat itself, but it rhymes. And so what that's saying is we do see patterns in the market, and when we see these divergences, when we see capital flood into one asset, we want to be cautious not to chase after a hot return. Now, what this has led to is a massive run-up in ETFs. The popular theme of the day, as it was in 1999, as it was in 2007, 2011, 2015, is passive investing always wins. Well, there's one thing for certain in the market, and that is certainties never hold. Whenever you hear something always works, I would tell you start to take caution. The market goes through cycles. Right now, the market is cycling into ETFs. They are becoming more and more dominant for a number of reasons. However, if we look at this year-to-date chart on the left, the explosion of ETFs this year specifically is like nothing we have ever seen. And on the chart on the right, the difference in red, ETFs, passive investing, versus equity mutual funds, active investing, is really quite extraordinary. What does this tell us? It tells us that investors are starting to run to what's hot. They're starting to run to ETFs and passive investing, and they're starting to do so during one of these divergent periods, which in the past has signaled a time for active managers to outperform. So we love to put capital where capital is scarce. Capital is scarce in active management. Additionally, we're seeing a massive separation in value versus growth stocks. This next chart shows that value stocks are actually getting as cheap as they have been since 2000, since the tech bubble burst. So as we can see, in 2000, value stocks, nobody wanted them. Everybody wanted tech. Everybody wanted exciting. Everybody wanted the hot return. That was actually one of the best times in history to buy value. Value relative to growth ran up significantly through 2007, as is shown by the chart. Since 2007, they've come down, and in 2015, they touched their 2000 levels, slight recovery, and now once again touching those 2000 levels. Again, we think that this is a good area and a good time to look at valuations. Always fundamentals first, not necessarily market emotion, always fundamentals. Now, additionally, as we've discussed, traditionally, when we see these divergences, volatility is not far behind. Now, we don't know if that's going to happen this month, next month, or in 6 months. But what we do know is corrections happen and bear markets happen. They're unavoidable, and in fact, they are healthy. They correct over pricing. What's important during these periods of time when stocks are elevated and everybody wants to chase after the return, to remember the core basic investment principle: buy low, sell high. When is the right time to take on risk? Is it when prices are elevated? Now, that's not to say we run away from the market. As we can see here, and we look at the chart on the left, the power of compounding, over time, it has paid to be in risk assets. It has paid to be in stocks. We want to be in stocks. However, this is not a time to throw caution to the wind and run after the currently higher valued, if not highly valued, securities. The chart on the right shows exactly why. We want to make sure during periods of volatility, we can try to minimize our loss and take advantage of downturns to acquire more assets. In other words, have some dry powder on the side. It makes a big difference. If you can give up a little bit of that hot return, the benefits are pretty significant. Just take a look at this chart. If your portfolio goes down 10%, you need an 11% return to recover. Makes sense. $100 goes down 10%, that's $9. You go back up 10%, that's only $99. You need 11. The average bear market is 30%. Well, if you track that market down 30%, you need a 43% return to get back. And 50%, of course, needs a 100% return to recover. So what's important here is don't take the big losses. And if you have some dry powder, when the market has volatility and you can put that to work, you can take advantage of a mispriced marketplace. And in a market like this, we want to make sure we stay diversified. One way to hedge risk in your portfolio is to diversify in alternative investments. So the question is, when is the right time to buy those investments? Well, the truth is, it's always good to have alternative investments in your portfolio to diversify. However, there are periods of time where they are more attractive than others. So if we think about alternatives and we think about those as a diversifier or a hedge of risk, then when markets are very low, we don't want to hedge risk, we want to take risk. That's when things are cheap. When markets are very high, prices are high, that's a great time to hedge a portfolio. However, like every other asset in the market historically has done the exact opposite. Let's take a look at the chart. This is a classic buy low, sell high chart for alternatives. The way the chart lays out, wherever you see blue, alternatives outperform the market. Wherever you see red, the stock market outperforms alternatives. So if we think about it conceptually, we want to buy alternatives or hedges against risk right before something bad happens in the market. And when we hit bottom of the market, we want to pull out of those hedges and buy the stock market and catch the upside. Yet what this shows us is people have done exactly the opposite. 1999, top of the internet bubble, a perfect time to put hedges in a portfolio, perfect time to lower risk. And of course, what happened? People were running away from these funds. They were pouring money into the stock market. And exactly at the moment where the stock market's outperformance hit its peak, the stock market turns and no one was in these funds. Now, for the next several years, 2000, 2002, the stock market has a big bear market. Alternative investments do their job. They make money, they diversify. And so in 2003 and 2004, everybody looks at these hedges and says, I wish I had those. Money pours in. Of course, that's right when the stock market takes off. We see a multi-year run leading into 2007, 2008. Again, the S&P 500 outperforms these hedges. That hits another peak in 2007, just before the financial crisis. Best time to buy hedges. People were buying the stock market. 2009, the stock market takes off. Here we are again, 2014, 15, 16. This chart calls it the QE bubble. I don't know if we're quite all the way to the bubble yet, but clearly we're at elevated prices. And there is almost no interest in hedges or safe, solid, steady returns. We obviously like alternative investments right now. We like that diversification. Specifically, we like private equity. Small niche private equity seems to be a good place to put money, drive cash flow, drive returns, stay away from some of the elevated valuations. So that's our market commentary. Theme of the day is we're in an environment where we're not calling for a bear market. We're not saying the market's ready to turn over and drop 20%. However, we are saying that prices are elevated. The market is diverting, volatility is very low, and caution in the credit markets is very low. And whenever we get a lack of worry, that means we get elevated pricing. So it's a time to take caution, it's a time to be careful with our asset allocations, and it's a time to add some diversification. So with that, if you have any questions about any of this material, please don't hesitate to call us. And now, for the very first time, the Verdence Capital Advisors disclosure document. Thank you. Have a great day.